This is the $1 trillion show. This is where we aim to save $1 trillion in taxes. In fact, I actually sent out an email today about how all the fight that's going on in Congress right now with the government, it's not talking about the budget and deficits and all this kind of stuff. It's not a tax problem. The taxes are the solution, actually. So one of the things I've discovered over the many years I've been doing taxes, over the tens of thousands of tax returns I've done, is that there is no amount of money that you cannot spend. And that's true for people, it's true for families, it's true for companies, it's true for governments. So it's not the money coming in that's the issue, it's the spending going out that creates the problem. And, what we figured out during COVID was that Americans will not tolerate 10% inflation. If you get to 10%, you're getting voted out, end of story. And so the key to restraining government spending is to restrain the amount of money that they get, because they can print some, they can print 10%. The rest of it has to come from tax money somewhere. And so the government, the federal government, gets about $4.5 trillion worth of tax payments during the year. That's plenty. It's not an income problem for the government, it's a spending problem. And I was making that point in my emails where what we aim to do here is we want to restrict the amount of money going to the government. I want everybody to keep as much money as possible. In fact, we were on a call with a client earlier today, and we were going over how that's going to be. And he's made the transition this year from partially employed, partially has his own business. This year he's full-time in his own business. And what are the things that we can do in order to optimize all that while complying with all the regulations, doing it in as advantaged way as possible and saving him tens of thousands of dollars. So that's kind of what we do here. If you're new, I'm Neal. This is Tax Sherpa. This is our $1 trillion show. On the call here with me, we've got Serena and Fatma. Serena is our doer of all things.
That's true.
Fatma's our admin. She, if you're communicating back and forth, you're probably talking to Fatma, even if Serena and I are talking behind the scenes, because she's the one who handles all of that and makes things communicate, which is fantastic. So on the show, what we do is generally I'll give an update. Lately, tax news is usually slow. This year has not been slow with tax news. I'll share some updates with the legislation that we're looking at, with the big, beautiful bill, as Trump likes to call it. And we'll talk about some of the ramifications of that. I also have a little calculator that I'm going to share with everybody. It's still in testing, but it's a handy little tool. And then we'll do questions. So we get, I don't know, 100 questions a week, something like that, from different people. And we'll just go through as many as we can before we run out of time. So with that, I'm just going to jump straight in. Normally I have a slideshow and everything, but there's not enough time. So let's go and I'm going to do a share. Screen number 1. The one big, beautiful bill. That is what we are looking at for the tax legislation. So this was the House version. So this already passed the House and then went to the Senate. And currently there's a big argument going underway in the Senate. So this is not going to be the final version, but this is what we have so far. And we can glean a few insights into what's going on by going through this. So the big effect here is that most of the Tax Cut and Jobs Act is going to be made permanent. So if you remember way back when in 2017, the Tax Cut and Jobs Act was passed in a 10-year horizon. And that was because of the budget reconciliation process. They were able to, it's not that they had to do 10 years, but that's kind of like the scoring that was used by the CBO, the Congressional Budget Office. And they had all these tax cuts and they had all these tax increases so that they could get it passed and justify to themselves what was going on. Those are all expiring 2026. We're coming up on time. And it just so happens that Trump is back in office. Worked out legislation-wise, it unusually in that scenario. So one of the things, or the first thing that this bill does is it makes those Tax Cut and Jobs Act changes to the structure of tax permanent. So instead of a 10-year window, it just says ongoing. But there are a couple things that do have time windows on them of 4 years and 6 years, but most of it's going to be locked in until there's another tax reform. So what does all that mean? It pretty much means what you've gotten used to over the last 10 years is going to be keep going. In the old days, we used to have exemptions. Those are gone. Was based on the number of people in your household. We're going to keep the larger standard deduction. Inside of the itemized deductions, there's a lot less that you can deduct compared to how it used to be before Tax Cut and Jobs Act. Stuff like moving expenses is going to remain non-deductible. And going along with that kind of theme, all the basic changes will remain in place. And then there are tweaks. So one of the tweaks that is interesting is the qualified business income deduction. So QBI, qualified business income, was created in Tax Cut and Jobs Act in 2017. This was a new concept where this is flow through income. It could be from Schedule C as an unincorporated business. It could be from an S Corp. It could be from a partnership. It could be from real estate. It could be from a farm if you're a Schedule F filer. And the income from those were potentially deductible up to 20%, meaning that if I have $100,000 of activity income from one of these qualified businesses, then I might only be paying tax on 80 of it, potentially. Caveats apply. And there's a 20% deduction possibility. And in this bill, at least in this version, they're going to raise that to 23%. So it will be interesting to see if that carries through. Other things, little tweaks. In the original Tax Cut and Jobs Act, there was a horrendous revision to R&D expenses under Section 174, and they're fixing that because what they had done is back in 22, there was like one of these time windows went into effect where if you had R&D expenses like you're a software developer, software was hit especially hard, you weren't able to deduct the amount of money that you spent on salaries and computers and whatever. You had to amortize it over 5 years. You got a credit, yes, but generally the credit plus the 10% deduction you got in the first year was less than what you would have gotten from the deduction. So you're actually spending cash, but not able to deduct it, and then having a larger tax bill, this phantom income that you have. So that was a major problem that's persisted the last couple of years and is fixed in this version of the bill. So it'll be interesting to see if that remains. And so this is 389 pages. I've read through. I've skimmed the whole thing, but it's a lot, and obviously is subject to change. So I'm not going to get too bogged down in the weeds. The most interesting thing about it is the new MAGA accounts, and it doesn't stand for Make America Great Again. It stands for something else. I can't remember off the top of my head. But basically, this is for kids who are under 8 years old. It basically works like a 529 plan with some changes. So instead of only using it for education expenses, you can use it for buying a business, which is an interesting idea. You have to have financing on a business in order for it to qualify for qualified distribution under these proposed rules. You can use it for buying a house, you can use it for education. So it's a supercharged 529 plan. And it's possible that the government will kick in $1,000 upon a baby's birth if this gets passed. So lots of sections, lots of stuff going on. In here is also no tax on tips, no tax on overtime, no tax on Social Security benefits is not here. So what they did instead was they gave seniors a $4,000 extra deduction, which is okay, great, but that's not what you promised. There's that. And yeah, so the laundry list goes on, but all subject to revision because now it's in the Senate. So in the Senate, there are a few things going on that people are arguing about. So one is the SALT cap. So SALT is state and local taxes. So under Tax Cut and Jobs Act, the SALT deduction was limited to $10,000. So if you live in California and you own a house and you're paying 12 grand in property taxes and you're paying another 15 grand in income taxes for California, you have $27,000 of those expenses. The amount you can deduct on your federal taxes is 10. I've seen people who are highly paid employees in New York, New Jersey, those kind of areas, paying $60,000 in state income tax, and they get to deduct 10. And so that's been an argument since the Tax Cut and Jobs Act was created, and it's still an argument now. Do they lift the cap? Do they eliminate the cap? Do they modify it? All these kind of back and forth things. So that's one major area of contention. Probably the most important one for most people. There's some other technical things. The CBO was out with a report, I think it was yesterday, saying that the tax bill as written is going to add $4 trillion to the debt over the next 10 years. Maybe that's true, maybe it's not. CBO projections have never been right about anything. But, but take everything with a grain of salt at this point. Until we actually see what actually gets passed, then we'll know what's in it, and hold your expectations until then. If and when we do get a bill that's passed, signed into law, we'll go through all the different details of what's going on. But just be aware that this kind of stuff is proceeding. Like I said, past the House, now to Senate, then it has to go back to reconcile between the two versions, and then theoretically it goes to the president. I think it was Bessent, Secretary Bessent, who said he wants a bill presented as part of the July 4th ceremony as a big to-do. That's, at this point, not too far away. It's about 6 weeks. Maybe it gets done. First they said April, then they said Memorial Day. Now they're saying July 4th, so we'll see. It is what it is when it comes to politics. All right, so that's the quick news update. The little tool I wanted to share with you, this is still in testing. This is a retirement calculator that I coded up, I guess, last week. And one of the things that bothers me about retirement planning calculators, and you'll see a lot of these, is that they don't really do a good job, at least in my opinion, of inflation adjustments. So I'll give you a quick example here. The way this one works is we put in today's numbers, today's dollars. How much do you think you'll get in fixed income, like Social Security or pension? Maybe you're a teacher or firefighter or something, and you're able to get a pension, unlike the rest of us schlubs out here. And, what are your monthly expenses in today's dollars? And what it does then is that it inflation adjusts everything, and you can put in your expectations of your portfolio growth, and then it'll give you like a number of like how much do I need to put in every year, also inflation adjusted, to reach my goals. So let's say I go to SSA.gov, I have an account, and I figure out if I retire now based on their assumptions, I'm going to get $2,200 a month, let's say, which is middle of the road ish. Let's say my mortgage is $2,500 a month. Let's say my healthcare is, I don't know. And if you have a family, you got to think, okay, by this point, the kids will be gone. So let's say that's $1,200. Living expenses, let's say another $2,000. Travel, people like to travel when they're retired. Say $1,000 a month. And you can add stuff if you want. So that creates a monthly shortfall of $4,500 between the $2,200 here and these numbers there. And so based on that, what is my withdrawal rate? So this is a concept you'll be familiar with if you're in personal finance circles, the safe withdrawal rate. The landmark study for that was the Trinity study. And basically they determined if you have a mix of stocks and bonds and you withdraw 4% a year, also inflation adjusted over time, then chances are very good you'll have money at the end of 30 years. So 4% is kind of the standard number, but you can adjust it. You can go up and down depending on what your particular portfolio is like. And then we go into years to retirement. We can say, okay, I've got 20 years to retirement. Sure. I happen to be 45, so that works. And then you can put in, what do you expect for inflation? 3%, 4%, 2%, whatever. Up to you. And what's your investment return going to be? Average-ish, again, 7% is kind of standard, but you can adjust it. Obviously, the higher your investment return, the better. We want to be realistic. So let's say I have 7.5%, okay? So if I had no savings, no portfolio at all, in order to reach a portfolio that inflation adjusted, it needs to be $2.4 billion in 20 years, I would need to invest $56,000 a year to reach these numbers, to be able to withdraw 4% to pay for all this. That's the idea of the calculator. And then you can see how the cash flows change over time. Now, if I already have some money, let's say I have 250 grand in a portfolio, now my investment required drops down to 31,000. So it's not nothing, but it's definitely less. So the goal here is to give you an idea of the scope of the issue, because what I see over and over again and have seen for the last 15 years, is that people fail on the retirement savings in two areas. So number one, you got to put enough in. And that could be 401ks, it could be IRAs, it could be taxable accounts, it could be whatever. Real estate, I'm agnostic. Different plans have different tax consequences, but they all do the job in some form or fashion. The other element is you got to leave it alone. You got to leave the money alone to do the work and not take it early and disrupt the growth. If you can do those two things, retirement works. If you can't do either one of those things, if you can do one but not the other, it still doesn't work. The key is to get that idea of what's going on. And maybe it means these numbers need to be lower and you need to have a lower standard of living compared to, the resources that you have available to you and going on into the future. Just being aware of the issues. That's really what it comes down to. I will put a link to this. This is still in the testing phase. If you have any feedback, definitely let me know. But I'll send out a link to everybody on our email list with this so that you can play around with it and let me know what you think. All right. So that's my updates for this week. And let's move into questions. I know we have a giant backlog because we've been gone for a few weeks.
Most definitely.
So who wants to go first?
I'll go first. So we did have a question that came in. It's a general tax question. Someone wants to know, what's the smartest move someone can make right now to lower their 2025 tax bill?
Okay, so
that's a big.
Yeah, it depends. Yeah, and that is the answer to all tax questions. But so it depends on what your situation is. So if you were a W-2 employee, what's the biggest thing you can do to save on taxes? The easiest thing to do is to contribute more to your retirement account. You'll hear that from financial planners and everything. It's like, oh, just put money in 401k, it's tax deduction, blah, 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 which is true. But it's not necessarily the most powerful because there are limits involved. You could do things like get into investment property because there are lots of advantages to doing rental real estate. You could start your own business and be able to change the order of things. That's generally the most powerful one. So, the difference between an individual who earns money as an employee and somebody who's a business owner is that an employee earns money, then they get taxed, and taxes are taken up front, and then they have the remainder to spend. A business brings in revenue, it spends on expenses, and then gets taxed on the remainder. So that difference in order makes all the difference in the world. People talk about Amazon all the time. It says, Bezos didn't pay taxes for 20 years, which is true. He didn't. And the reason was because they reinvested all their money for 20 years and had no profit. And they were just selling on the stock exchange the dream that one day they would turn a profit because they're building this bigger and bigger thing. And it worked. Sometimes it doesn't work, but that is the game. So they had no income with which to pay tax because they spent it all. And on a business side of things, you're only taxed on the net, not on the gross. As an individual, as an employee, you're taxed on the gross. And so if you change those things around, move those pieces upside down, then that's going to be, in general, your most powerful tax saving strategy. But that's not available to everybody. So it depends on your situation, depends on what you can do. And part of the difficulty of the tax planning world is that everything is unique. Everybody's situation is different. Even if they rhyme with others, your number is going to be different than the person next to you. If you need more specific help than that, then you'd set up a call with one of our planning experts, and we can figure out your particular situation and what you can do to save the most on tax.
Because all our plans are personalized to the client.
Everything is custom.
Mm-hmm.
I wish it wasn't.
Yeah, it would be a lot easier for us, but hey.
That's why if you want to do the DIY approach where I know my own situation, I need pointers, that's what our navigators group is for, where you can have access to all of our tools, the same tools we use internally and that I've built over the years, and then you can use those tools in your own situation. So that is an option for those people who are more do-it-yourself oriented.
Yeah. We have a question, boss, from one of our clients, and he asked if someone runs a side hustle at one point, should they treat it like a real business for tax purposes?
Absolutely. So that should always be treated. There's people get hung up on this hobby loss rule. So you've probably heard this thing: if you lose money in 3 years in a row, then it's not a business anymore. And that's a vast oversimplification. But what does happen is that there is this concept in the tax regulations of whether something's a hobby or a business. So if something is a hobby, you do get taxed on the gains. You do not get to deduct the losses, which is crazy, right? But it's just how it is. So if you make money just by happenstance, you owe tax. If you lose money because it's a hobby, that's just you spending money. But if it's a business, then whether you make money or whether you lose money, you're going to have tax implications. Most businesses, at least in the beginning, lose money, and most businesses fail. So most businesses lose money every year, as a matter of fact. And so then there comes into this question: is like, what about this 3-year thing? And so what the 3-year test is that if the IRS were to come in and examine your business activity, if you lose money in 2 out of 5 years, then the burden of proof is on the IRS for them to prove that you don't have a business and that you do have a hobby. If you lose money in 3 out of 5 years or more, 3 or 4 or 5 out of 5 years, and the IRS were to come in and examine that, the burden of proof is on you to prove that it is a business and not a hobby. So that's where the roles get reversed in that 3-year thing. And what does that mean to prove that you have a business? That means you do the things a business does. You have a separate entity. You have separate bank accounts. You don't commingle funds. You maybe have a website, depending on what kind of business you have. Maybe you do some advertising. You keep your books in order. You're required to keep records as a business. For a hobby, you're not. You should if you're making money. If you're just spending money on whatever. So what's a hot hobby right now? I keep seeing, maybe it's just my algorithm on Twitter, but I keep seeing these guys they're these tether cars that they're racing at 200 miles an hour around a track.
Really?
Yeah, it's just, people are into all kinds of stuff. So if that's your hobby and you're spending money, then you don't really have to keep track of anything. But if you're making money, you're winning prizes or whatever, then you do have to keep track of that sort of thing. So if you have a side hustle, you should absolutely be keeping track of things, in a real business kind of way. Separate accounts, whether that's into an LLC or a corporation or just under a DBA or under your personal name, those are different kind of questions. But you should definitely have a separate bank account. You should be keeping track of income, keeping track of expenses, and doing all the things that have the form of a business, because you do have a business, regardless of how big or small it is. Yes, that is one I can answer definitively. Treat it like an actual business, because it is.
I'm just thinking to myself that when a person opens a business, they think that's it. No, that's only the beginning. It's so much more to owning a business.
Yeah, it is. There is work involved.
Yes, you have to do work.
It'd be nice to just say, "Oh yeah, it's a business," and then just be done. That's not real life. Yeah.
So it looks like we have another question that came in. It's a real estate question. Someone wants to know, how can a W-2 earner take advantage of the real estate losses on their taxes?
Yeah, so the real estate losses, there's three different scenarios. So rental real estate, by default, unless an exception applies, is considered passive. And so under passive activity rules, you are limited to $25,000 of deductions. Now, another thing about rental real estate is that for tax purposes, it's almost always a loss, because even if you're cash flowing positive, you have rent, but then you have expenses, you got your mortgage, you got your utilities, HOA, whatever, you might have a positive number there. But in rental property, we also have depreciation, which writes off a portion of the structure over time. So with standard kind of depreciation, you're generally running off about 4% a year. And that is usually enough to kick you into a loss for tax purposes. So the question is how to use that. So you can use up to $25,000 of losses under if your income is under $100,000. And so let's say you have a W-2 of 80,000 and you've got 3 properties which are generating a whole bunch of losses combined. And so you'll have a minus 25,000 on your Schedule E, which flows through Schedule 1, which flows into your 1040. And that's going to reduce your income from 80 down to 65 or 55. And that lowers your taxable income and that lowers your tax. So that's thing number 1. As you make more money, that deduction of 25,000 shrinks. Once you get to 150,000, it goes to 0. And whatever tax losses you have generated over and above 0 carry forward into the future. That's called you look at your Form 8582 for your passive activity loss limitation disallowances. And so that money rolls forward year after year, building up in many cases, until either your income is low enough in order to capture that $25,000 a time, or until you sell the property. And at that point, those unused losses will decrease the gain that you have to pay tax on, if there's a gain. So that's scenario 2. Scenario 3 is where you're a real estate professional and you're able to demonstrate that you, or I want to say you, a lot of times it's a spouse or something like that, spending at least 750 hours a year and at least 50% of your time involved in real estate activities. And then there's a grouping election, and there's specifics that go into all that. But if you're able to satisfy those scenarios, then you're able to convert that passive activity into an active trader business, and then you can take those losses without limit against your other income. So that can be extremely powerful if it applies to you. And there's various ways to do that. The other thing that I mentioned was, by default, rentals are considered passive. That is not true if your average stay is less than 7 days. And this is your short-term rental stuff. Whether you're doing Airbnb or VRBO, or you just have a condo in vacation destinations where like everything is managed by an on-site place, that's all short-term vacation stuff. If the average stay is under 7 days, then those rules don't apply. They all get thrown out the window. So if you're investing in those kind of assets, then you don't have to do anything else, and whatever losses are generated will be deductible. So you got to be careful and make sure you keep logs of your stays, make sure that the average is under 7 days, and then you can play that game. Yeah, there's a few different scenarios where you can take those losses. The real limitation one is if you're over 150,000 of income and you're passive. If you're in that situation, your losses get suspended and roll over into the future.
Yeah, so for my next question was, should parents pay their kids through their business or use 529s or both?
If you had to pick one, I would say pay your kids. Well, possible exception to that. So there are different kinds of 529 plans. So there are prepaids and then there are savings or investment accounts. So like Florida has a prepaid plan where if you're a Florida resident and your kid's going to go to Florida schools, then you can prepay whatever their college tuition would be. And it's way cheaper if you start 15 years in advance. And there's different plans and everything. And different states have different rules as far as who can buy into it. Some states you can be out of state and still buy into their plan and get into their rules. So if you have a prepaid plan, that's probably going to be the most cost effective for college savings. And like Florida will pay another state an equivalent amount of what they would have paid to a Florida school. So there's things like that to navigate. If it's a 529 investment account where I'm just putting money in and it's investing tax-free as long as it's used for education purposes, then you're going to be better off typically paying the kid through your own company. Now, before people lose their minds, there's a couple caveats to go along with that. One is the kid has to do something, right? It's got to have a marketable skill that you would pay for. And that's going to depend on the capability of the child. Generally, it's between ages of 8 and 17. That's available. But if you set it up right, you can pay a child potentially as much as $22,000 a year, at least for this year. The number changes with standard deductions. Set it up right, you can pay them 22 grand. You can put 7 grand into a traditional IRA. Then that leaves them underneath the standard deduction, and so that will be totally tax free from federal income tax, free from Social Security tax, free from Medicare tax, free from federal unemployment. In most states, it'll also be free from state unemployment tax. And depending on the state, you might have a state income tax amount, or maybe not. It just depends on how that particular state operates. And so that's a possibility, but it has to be backed upable by what the kid's doing. When they're younger, typically we're talking more low skilled kind of stuff. They're cleaning up the office, they're taking out the trash. I've got my 11-year-old, she does all my filing and opens my mail, scans it, puts it in the computer and all that kind of stuff. And she does the shredding. And in your market, you have to figure out whatever that's worth. So like in my market, it's actually a decently paid job to be an office admin like that. Now, she doesn't rack up a whole lot of hours. It's whatever she does, she gets a good rate for. As they get older and they become more capable, a lot of times I'll talk to parents and I'll say, what you should really be having them doing is your social media management. So 1, that's a real job. 2, it has real impact on your business. 3, they are better at it than you are. They're better at the Instagram. They're better at Facebook. Maybe not. Facebook's for old people, but they're better at all the social media stuff than we are, because it's one of those generational things. They could be doing research on your competitors. They could be planning out your posts. They could be responding to doing all the replies and DMs and whatever. That's solid work that they could be doing, and it's a highly paid skill, depending on where you are in the country. If you do that, now you have a tax-free way that's a deduction to your company, is tax-free to them, and is able to shift a good amount of that income over and creates that tax savings. And on top of that, the biggest pushback I get when I talk to people about putting their kids on payroll is like, I don't want to pay my kid 15 grand or 10 grand or whatever the number is. And my point is that you're doing it anyway. So there's no kid who is free. We're starting all of the summer classes right now, so I got to pay for this camp, pay for that camp. There's swim team, and then there's sleepaway camp, and whatever else. I don't know. My wife just says, "Oh, we're spending this much." I'm like, okay. They have a great time, so that's all good. It's expensive, right? So instead of the parent paying for it, the kid pays for their own stuff, and that's how you're able to get the tax deduction and make good use of that money rather than just handing your kid like $10,000 or whatever. Because you're still the parent, you're still in control of the funds, and then you get to have all the conversations about money with the child as they're growing up in a way that they can understand. It's like, okay, you want to go to sleepaway camp this year? That's $400 a night. Like, okay, we can do that. Whatever other conditions you have as a parent are satisfied, and you can go, and the bank account balance is going to go from this down to this, okay? And then they say, hey, do I really want to go? Because it's their money, right? It's got their name on the account. So then then they start making those hard choices. Do I really want to spend that money? What does it mean to budget? What does it mean to have one thing and not another? Opportunity cost and those kind of things. It's one of my favorite things just for the development of the kids' financial acumen. Even if there were no tax benefits, I'd still have my preference to do that. But there are tax benefits. So yeah, might as well use it. And because the amounts you could potentially shift over are larger than what you can do with a 529 plan, then it generally makes a lot more sense. So if you have 529 prepaids, that's a good deal. 529 investment accounts, less of a good deal. Kids on payroll, great deal. As long as the conditions are satisfied.
Understood. I'm just thinking that if a kid has to pay for the summer camp, that's less kids going. They're like, no, thank you. Not this summer. I have a question from a client that just came in. It looks like they're moving to another state or thinking about moving to another state. They want to know what should they consider tax-wise before moving to a no income tax state. What should they look forward to?
Yeah, no income tax states I like them generally. Tennessee, Alaska, Washington, Florida, Texas. I think I'm missing one or two there. Oh, New Hampshire just went tax-free.
Oh, wow.
Yeah, it was New Hampshire. Mississippi is going tax-free, but in 10 years or something. It's some weird plan that they came up with. So yeah, so there are considerations. So one is in the year of your move, you're going to be a part year resident in one state and a part year resident in the other state. And you got to make sure that the withholdings for the different states are correct. So it like California is a great example of this. California is very aggressive. Like if you move out of California, but you're still receiving money from California, you're still going to be paying California tax on it. Um, if you move from California to Florida or California to Texas, but you keep the same job and now you're just working remote, you're still paying California tax. And there's other states that have similar kinds of arrangements. Usually, if you're in two states, your home state will give you a credit for the tax you pay in the other state, and that'll reduce your home state tax. So if you're in New York and Connecticut or something like that. However, if you're in a tax-free state, there are no taxes on the other side, and so that home state will take the whole thing. So that's something to be aware of. Some people get caught by that and are surprised. I thought I was here. Yeah, but your source is wherever it's coming from. If you're getting a new job and that new job is in the new place without taxes, then that's fine. Then you don't have that same issue. There are some states will directly apportion your income. So, okay, I earn $5,000 in this state, and I earn $10,000 in that state, and I just pay tax based on whatever those numbers are. Other states will do a percentage of gross income. So it might be that the state you don't live in has $5,000 of income, and your overall income total is 25,000. So then they'll say, okay, 5 out of your 25 is going to be from our state, and therefore we're going to assess you a tax based on that percentage. But what happens when you have adjustments to that income that actually lower your home state tax? So what happens in this kind of, if you have investment real estate like we were talking about, and that creates a negative on your taxable income, that negative reduces your total income, which increases the percentage of that other state's comparison to the whole. So you actually get taxed more in that other state. And again, every state is different. And so there are several different approaches that states have taken over the years. And so you have to make sure that you are aware of whatever one you're dealing with in the state you are moving from. Also, the state you're moving to, unless it's one of those tax-free states. Yeah, it can get complicated. Moving expenses for most people are not deductible anymore federally, but some states they are. So California kept their moving expense deductions. Most states follow the federal, though. There's individual differences like that. 2106 expenses. So this is one of those things that was wiped out by Tax Cut and Jobs Act, but California kept theirs. So for state purposes, you can have certain deductions that aren't allowed federally, and you should just be aware of the states that you're involved with and how that's all working out. So in short, it depends. But by and large, if you're moving to a tax-free state, that's generally going to be better monetary wise when all said and done. There are other costs though. So like property taxes, so like Texas is becoming famous for this, where it's like, yeah, we don't have any state income tax, but our property taxes are high and our sales taxes are high. Florida, property taxes are reasonable-ish. Insurance is very high. Sales taxes are middle high-ish. So, how each state handles, because every state government is going to raise revenue in some fashion. And it's just, is it coming through income taxes? Is it coming through property taxes? Is it coming through sales taxes? You're going to be paying the piper one way or another. And you want to look at that total tax load when it comes to all those different things in terms of how it affects your particular situation. And go into it with eyes open, knowing that, so that you're not blindsided by, I thought this was a tax-free state, but I got to pay 20 grand a year in property taxes. They're getting some amount of money somehow. And whether the per capita amount that you would be responsible for comes from pocket A or pocket B, does it really matter? I don't know. I actually would prefer income tax over property tax because there's more you can do to affect income tax than you can to affect property taxes. So there are people who make, yeah, there are people who make a hobby out of protesting property taxes. It's, your results tend to be limited. So yeah, just things to be aware of when you're moving states.
Yeah, so for my next question, boss, is what is the tax smart way to support aging parents financially?
Ooh, that's a tough one. So there are all different kinds of situations. Most elderly people are gonna end up with some kind of taxable income. And some people, sometimes mom moves into the in-law suite and becomes a real dependent. But that's relatively rare these days. That used to be much more common. And so the what it comes down to is the fact that especially as people age, they're going to need more and more help with their situation as far as managing their finances. And that's true of taxes, it's true of everything else. There's telephone scam calls and all kinds of stuff that you have to be mindful of as parents age. But one of those things is taxes. So I have a number of clients who coming into the office and it's 94-year-old woman and her 60-year-old son or whatever it is. And he's helping her just manage all the stuff because faculties are kind of there, not, and she can sign stuff and she understands what's going on, but keeping track of all these different numbers is tough. So really just being there for them and helping them manage all that is really the key element. There can be times when it makes sense to have different arrangements. If they go into managed care, that's a whole separate thing. But even then, had a client this year who went into managed care, passed away, but still had like giant amounts of retirement income. We had still had to file their own final tax returns and everything. In those cases, there's a special thing with managed care where a portion of your rent is typically counted as medical expense, but that's case by case. It's hard to give generalities there beyond just being involved and making sure that money's being saved and not. I can tell you stories. I had one guy come in. This was years ago. Comes in, his wife passed away, and they were not super old, but like 60, 70, something like that. He brings in his stuff, and he's getting all these weird notices in the mail, all these amounts due from stuff from the bank and all this kind of stuff. And as it turned out, that his wife who had passed away was a huge gambling addict and had kept it hidden for however many years. But now, then she passed away, and all the notices that had been coming that she'd been intercepting, he was now getting, and he had no idea about any of this. Whether it's that or whether I've had retired people come to me and say, I'm going to invest all my life savings into the Iraqi dinar because it's going to make me $1 billion or whatever. And I was like, okay, I'm not your financial advisor, but that sounds dumb. So there are a lot of people out there who prey on the elderly with all these different scams and everything. So make sure that you're there to prevent all the money from being spent frivolously, because there are real world consequences. Because let's say your mom or whatever is getting on in years and she has a pension from whenever she worked and she makes whatever. She between Social Security and her pension, she makes 60 grand a year in retirement. And if she then takes that $60,000 and sends it to scammer X, you still owe the tax on the 60,000, right? That's a problem. So there's not so much, there's less to do with strategy. There are some things you can do, but again, very dependent on circumstances. But by and large, the biggest thing to do is just be involved, make sure that things are being taken care of, make sure taxes are being filed, make sure paperwork's not being lost. All these kinds of things is really what comes into play when it comes to the elderly. So that's it depends for that one.
Yeah, and I totally agree with that, Neal, because My aunt stays with my mother, and literally $349 every month she was giving over to these scammers. We didn't know about it. She was doing it for 5 years. Can you imagine that?
Yep.
So, couldn't believe it, but yeah, I agree. Totally agree there. So we have a tax planning and wealth building question. Someone wants to know, what do the wealthy do differently with taxes that most people miss?
It's hard to give one answer to that, but the vast majority of wealthy people build wealth in a business or in real estate, one of those two, mostly business. So real estate is a great way to keep money. It's harder to build money unless you're really active with it. Some people have been successful at it, but it's great on defense. For offense, building your own business is number one by far in all cases. There's a quasi in between thing, like with tech companies. If you're like employee number 6 at some startup that becomes real successful, you can build a lot of wealth that way. And then when it comes to the planning, once you're at that level, there are different things that open up. There's any number of what I call the exotics strategies. And I call them that just because they require stuff outside yourself. So there's planning within your personal tax situation. There's planning within your own business that you 100% control. And then there's planning where, okay, we have to bring in this insurance guy and we got to do this, that, and the other, and it's going to cost 50 grand in fees. And that's some of the stuff that becomes available once your income is high enough, which they all work, but not all of them. Most of them work, but they are complicated. They take a lot of compliance work, and it's a big to-do. And the numbers involved there generally start at $50,000 to $100,000 worth of out-of-pocket costs. So it only makes sense once you're in like $500,000, million and up, which very few people are. But by and large, the best way to build wealth in a tax-efficient manner is to build up long-term capital gains. And the most effective way to do that, assuming you're successful, is in your own business. So I'm hardcore on entrepreneurship to do that. And then there are strategies that you can employ on the sale part to reduce taxes. Then you can sell to an employee stock purchase plan. You can do a 1202 exclusion. There's all different kinds of things that you can do at that point to mitigate the tax impact there. But as you're building your own business, the equity that you're building in the company, as far as brand value, is not taxed at all. You're building an intangible asset in the brand equity. In fact, I was just having a discussion on Twitter about intangible assets and how they're accounted for and all this kind of stuff. So that's the most cost-effective way to get to that wealthy point where it's like, okay, now I have a sale and I make 5 million, 10 million, whatever dollars at that point, and it's taxed preferentially because it's long-term capital gains. And then there are these other things that I can layer on top that can potentially cut that down even more. So like under 1202 exclusion, you could potentially sell your business for $10 million and pay $0 in taxes, at least federally. Some states will file that simple, but that's extremely powerful if you can get it to work. There are conditions. Like everything, there are conditions. Failing that, if you're not in business for yourself or your business doesn't grow to that level, then just investing on your own into long-term assets like stocks or real estate or whatever, and then either not selling them or selling them in a tax-efficient way, like with real estate, you can do a 1031 exchange. That is going to be a really powerful way to build wealth and either not pay tax or defer tax or mitigate it in some form or fashion. People like to jump on Jeff Bezos or pick your favorite billionaire to hate and say, so-and-so didn't pay taxes. Yeah, because what they did was they borrowed against their stock as collateral, and a loan to you is not income, right? Because you got to pay back. And just so happens that the way they pay back is they borrow some more money from some more stock, right? So they just keep that process going. And as long as the company or the asset is worth more and more, then that works just fine. And then you have your buy, borrow, die approach, where eventually you pass away, and then your heirs get a step up in basis, and everything gets reset at that point. But you're gone by that point anyway, so it doesn't matter. So yeah, so there are some things that are different in terms of those exotics that wealthier people have access to. They can buy into certain investments, certain syndications, and things like that is not available to people underneath a certain wealth or income threshold. But by and large, the things they do are similar. They're just larger scale. So investing in their own business, investing in their own portfolio, whether it's real estate or equities or bonds or what have you. And then just being smart about how they tap the value of those things so that they can do it in a tax advantage way. And in fact, the discussion Serena and I were just having a couple hours ago with a client, he was talking about the impact of taxes on wealth growth. And taxes are an enormous drag on wealth building because the average employee might pay 0% in federal income tax, but they're still paying 15.3% in payroll tax. And they'll say, well, the employer pays half, but not really, because it's total cost of employment to the employer. So they're paying 15% in FICA, Social Security, and Medicare tax. And it's like, what would have happened to their financial lives if they got that 15% instead? And then they were able to invest that over time and have that compound. It's an enormous difference over a working career. But that's if they were to actually take that money and build something with it rather than just consuming it through just spending that has no residual value. When it comes to personal finance stuff, it's all personal. It's very little finance, to be honest. You got to be the type of person who can defer gratification. And one of the things I've learned over the years is that building wealth is very simple. It's not easy, but it's very simple, and just requires you to go against every human instinct you have. If we go back to caveman days, it didn't make any sense to put something to work that would take 5 years, 10 years, 20 years to pay off because your survival demands were more immediate than that. Maybe you save for the winter, maybe, right? By and large, if you hunted a mammoth or whatever, you ate it then. That's just it. The ability to defer consumption when you have the ability to take it now is very hard to resist. And if you can't do that, then no plan is going to work. Unless you just get lucky. Your lottery winners and all that kind of stuff. But even they go broke because there is no amount of money you can't spend. So it has to become, you have to develop those personal habits in order to develop that base of wealth that grows over time. And then once you're there, then there's other strategies to employ. I hope that made sense. It was a little bit far afield.
Yeah, makes sense to me.
Good.
So, what do you think is a good time to start like tax planning, like as far as income wise? Like when would you say, okay, let's start now?
Yeah. So it comes down to how much work do you want to do? So if I would say from $1, you should be doing your own tax planning. When does it make sense to hire an expert like Tax Sherpa or other people who do similar kinds of things? It's usually $100,000 or so. That's where it starts to make financial sense between what it costs for somebody to come in and do the planning and work with your situation versus the benefit that you get out of it. So if you have your own small business and you're making $100,000, generally we can come in, we can make a big difference in terms of the taxes. And then the more you make, the more effective everything becomes because everything works on percentages, basically. But yeah, that's a good rule of thumb, but there are exceptions to everything. Sometimes we'll look at somebody and we'll say, okay, here's what you should do, and we'll kind of give you the rough map. And the impact that we're going to make is not going to be enough for you to pay us. We'll give you some resources, and when we would pay for ourselves plus a lot more, then we can do more. But for now, you're in a DIY kind of situation. And And other times, there are people who are making less, but because of their particular circumstances, we're able to sculpt things in a way that really makes a big difference. And that's a little bit rarer, but does happen from time to time. But yeah, 100 is a good rule of thumb to go by. And obviously, we don't speak for anybody else who offers tax advisory services. That's just for us here at Tax Sherpa. And we are coming up on the end of the hour here. So I think that'll be the last question for now. So if you're interested, go to taxsherpa.com. You can schedule a call, or you can sign up for our Explorers group. Explorers is free, and you'll get on our emails, and I'll share with you like the tools, like the retirement calculator that I built, things like that. And there's lots of courses in the Explorers group that are totally free that will show you through some of the basic tax planning, not only concepts, but also tools to achieve your own tax planning. You can go ahead and check that out at taxsherpa.com. And then if you're ready for more, then our next step up from the Explorers is the Navigators. That's our premium group where we get together every week, and they get basically everything that I do is included in terms of tools and courses and calculators and those kinds of things. And it's a good time. It's a good little group that we have there. And yeah, otherwise, we will be back here next week. Next week is the 27th? Yeah. So vacation mode is over, unfortunately. So we'll be back at it. And unless I'm sick. But other than that, we'll be here. And today, I found out that we are able to stream on Facebook again. So we're on YouTube, Facebook, LinkedIn, and X. So that's where we're streaming the show. And you can pick it up in any of those places. And yeah, we'll see you all next week.
Alrighty. Have a good day.
All right.
Have a good day. Bye.